U.S. nat gas futures extended their recent rise to $3.60 on Thursday, marking the highest level in over a year, driven by technical momentum, expectations of colder mid-January weather, and bets on stronger global LNG demand. Market sentiment has turned increasingly bullish as forecasts point to colder weather patterns developing in January. The Christmas to New Year's week is expected to be very mild, but initial indications suggest that an Alaska ridge system is forming, which typically brings cold temperatures to the United States. Essentially, a high-pressure system forms over Alaska, redirecting cold air that would usually move from the Arctic into Alaska and funneling it toward the United States. If that system fully develops, there's definitely potential for higher prices. However, the associated temperature impacts likely wouldn't materialize until mid-January. While the prompt contract has been climbing steadily throughout the week, the rest of the curve has shown only modest support, as weather projections beyond early January remain highly susceptible to revisions. The rally is likely getting an extra push from short covering as well. With a significant number of short positions still in the market, the upward movement could be prompting some traders to scramble and cover, especially with the possibility of a colder January weather pattern taking shape. In my opinion, January forecasts will be the critical driver here. If they trend colder, nat gas prices are likely to move higher. That said, I remain skeptical, given the erratic weather patterns we've witnessed in recent years. The 14-day outlook remains bearish, and 30-day forecasts are notoriously unreliable, often proving completely opposite to actual conditions. If the late January cold fails to gain traction in next week's updates, we could see a significant sell-off, dragging prices back toward the $3 support level. Another bearish factor beginning to emerge is the eagerness of gas producers to ramp up production in response to the recent price spikes. This behavior is typical in the energy markets, where elevated prices often incentivize increased output as producers aim to capitalize on favorable market conditions. However, this surge in supply tends to create a self-correcting dynamic, eventually putting downward pressure on prices. In other words, the high prices we're seeing now are likely to sow the seeds of their own decline, as the market adjusts to the growing production levels and rebalances accordingly. Natural gas futures have established a bullish footing above critical technical markers. Prices broke through significant resistance levels in the previous session, with the $3.35 mark now acting as potential support. A move above the $3.65 resistance could pave the way for a stronger rally. However, the likelihood of a downside correction is high at this point. If prices fail to maintain levels above the $3.45 threshold, a pullback toward the support zone between $3.35 and $3.20 could be triggered, warranting caution for traders. I find this scenario to be highly likely, as there is a considerable chance of experiencing another warm shift rather than a cold spell. This is especially true when we take into account the unpredictable and erratic weather patterns we've observed in recent years. The frequency of unusual temperature swings and unexpected weather events suggests that a warmer trend could easily emerge, rather than the colder conditions that might have been traditionally expected. Please like, subscribe, and comment to support the channel. See you in the next one.